Hi everyone, welcome to our today lecture. In our today lecture, we are going to discuss one of the laws of return to scale, and that is increasing return to scale, or we call it as simply IRS. Sometimes we also call it as decreasing cost, law of decreasing cost, or law of increasing return to scale. So now let's discuss that what is meant by increasing return to scale. Increasing return to scale means when marginal product increases with increase in variable factor of production and keeping other factors as fixed. It is called law of increasing return to scale. Simply it means that when you are hiring a new additional labor and every new labor is giving you more production as compared to the previous labor. So it means that uh, this is called law of increasing return. When every new labor hire gives you the more level of production as compared to the previous labor, that is called increasing return to scale. And let's discuss law of increasing return to scale in little bit detail. When percentage increase in all factor inputs cost proportionately increase in output. It also known as stages of decreasing cost. As I mentioned earlier, that law is also called decreasing cost. Uh, in given any production function, we are giving same wages to the every labor. So the wage is our basically our cost for the production. And when every new labor is giving us more and more production and we are giving same wage to the every labor, so it means that the extra labor which we are going to hire, it will now cost us less. So in this way we call it as law of decreasing return to scale. And this stage occurs due to economies of scale. And what does mean by economies of scale? When you are able to decrease your cost with increase in production. Your production increases and your cost is decreasing. That is called economies of scale. This happens when a firm expand, increasing return to scale obtained in beginning. So this is most probably the case in when a firm is started its business and it is at its initial level. Now we will discuss that what are the causes of increasing return to scale. The first reason or the first cause for the increasing return to scale or the decreasing cost is technical and managerial indivisibilities, and the second is higher degree of specialization, and the third one is dimensional relation. So there are some other also multiple reasons for increasing return to scale. Maybe you have hired new modern technology, or you are hired some skilled labor. So in this way your margin product increases and the cost decreases. And now we will discuss the examples of IRS or increasing return to scale. If the amount of inputs are doubled and the output increase by more than double, then it is said to be an increase in return to scale. When there is an increase in the scale of production, it leads to the lower average cost per unit produced as the firm enjoys economies of scale. Let's say for example you increase your input by 5% and your output increases by more than 5%, then it means that particular production function is showing increasing return to scale. Okay, you increases by your input by any percentage and your output increases by more than that percentage, then that particular production function is showing increasing return to scale. Reasons for increasing return to scale: more division of labors, use of specialized machines. What does mean by more divisions of labor? For example, we can say we can take the example of a factory where the shirts are being made. You know, there are multiple laborers working in that firm or a factory. One labor is only making the collar and the other labor is only stitching the button to the shirt, and the third labor is compiling or combining all of these three stages. So every labor is doing its own work in multiple times. So in this way, the labor is being specialized in his duty. So when you are dividing labors into multiple sectors, so in this way every labor is more efficient in doing his work. A labor who is working whole the day a same work, he may be more specialized in that work when he works next time. Use of specialized machines mean that now you have hired, or you have taken more number of machines into your firm. So in this way your return increases when you hire more number of laborers and your cost decreases. Now let's discuss all of these by a graph and some table work. As you can see that in here, the first column is showing the number of laborers and the second column is showing marginal product. What is mean by marginal product? The marginal product means the product which we have by hiring one extra labor, and the third column is showing the total product. As you can see that in this way, total product is increasing at increasing rate. Okay, when you have hired first labor, it give you 2 unit of production, and when you have hired second labor, the second labor gives you 4 unit of production. So first labor give you 2 units of production, and second give you more than the first one, and the third labor gives you more production as compared to the second labor, and similarly the fourth labor gives you the more production as compared to the third labor. So when you have hiring more number of laborers and every new labor is giving you more production as compared to the previous labor, then that is called increase in return to scale, and your total product is increasing at increasing rate. And here is the table, here is the graph for this marginal product. On x-axis we have taken the number of laborers and capital, or we can say the amount of input, and on y-axis we have taken the marginal product. You can see that at first the marginal product is 2. When we have hired second labor, the marginal product is 4, and when we have hired third labor, the marginal product is 6, and at fourth labor marginal product is 8, and goes on. And when we joint all of these points, we have the marginal product curve in case of increasing return to scale.